Hi, my name is Ron Matheson. I'm a Senior Vice President with WebsiteClosers.com. Today we're going to talk about managing the process. Now, in most cases, your company is the single most valuable possession you own. You spent a lot of years developing it and you have created something that is a great entity. And it's time to sell it and basically get the maximum amount that you can for your company. There's a lot of things that are going to go wrong between the start and the finish of your selling your company. And in order to make sure that we get it to the finish line, we've got to manage that process. And it's anything but a cookie cutter process. I mean, essentially, I've owned companies I've developed, bought, sold companies for the last 20 years. And I've seen everything and been through everything, and at some point you begin to understand what not to do during the process as well as what to do. And let's talk about the first thing. Most brokers come in, they package a company. They want it to be this glowing company that represents excellence and perfection. That's not real. There is no company out there that's perfect, including all the way up to publicly traded companies. It does not exist. So in essence, if it's not real, we're not going to take that route, because the bottom line is your company has some faults. It has some blemishes. We're going to expose those blemishes right up front, because what's going to happen is if we don't, we're going to get into the process. And basically we've created this illusion that does not exist. And so during the process of due diligence, they're going to find those blemishes. And when they do, they're essentially going to turn to me and they're going to be a little less excited, and they're going to use that to try to drive the price down because there are things they didn't know about, and they're going to be upset by them. And so rather than allow that, I would rather up front put it right on the table. I'd rather make sure everybody understood every detail, both good and bad, and when we get into due diligence, let the strength of the company represent itself, and let's not have a lot of those negative points coming out at a time where it's going to hurt the sale of your company and possibly get a buyer to even walk away after we've done all that work. So let's start with the first thing. When we start, remember, we're going to have to go through due diligence, accountants, lawyers. It's got to survive the rigors of all those problems. So when it comes time to writing up a contract, I want to make sure I cover everything from A to Z. Because if I don't, what's going to happen is you're going to have a lot of negotiation between beginning and end, even after the contract is written and drawn up and signed. So why would I want to allow more things to come into play that will wear both parties down during the process that I could have covered up front? So that's the first thing, is we're going to cover everything under the contract. Second thing is, let's talk about how we're going to manage the legal aspects. We recommend a transaction attorney, and let's talk about why. Normally what happens is this. In a business deal, the seller goes to his attorney and he says, I sold my company, here's the asset purchase agreement, go ahead and draw closing docs. That attorney is going to write documents that are so tainted to his client to make sure he covers every base at the detriment of the other side. And when he's done, he's going to hand them to me. I'm going to turn around and give them to the buyer. The buyer's going to call me a day or two later and go, is he out of his mind? I would never sign that in a million years. That's an insult. And I'm going to say, relax, it wasn't the seller that did that, it was his attorney. But already we've got an issue. Okay, you've got now doubts creeping into the buyer's mind. So what does his attorney do? His attorney is going to do the same thing that the sellers did. And he's going to turn around and write these tainted documents as well. And I'm going to have to go back and forth, and this can last weeks. Not only can it last weeks, it's going to end up costing a ton of money, because these guys are playing the billing game. It's all based on billable hours, and they know conflict creates billable hours, so they're going to create as much as they possibly can. How do we circumvent this process? What we recommend is a transaction attorney. Now, it's used a lot on the East Coast, but it's beginning to become more the norm across the country. Within a few years, every deal is going to go through, in my opinion, a transaction attorney. Transaction attorney is this. We go to an attorney. He does not represent the buyer or the seller. He represents the deal. Both parties pay half of that fee. So in essence, that transaction attorney writes up the documents. He writes as fair a deal as he can based on the paperwork he's given. He doesn't care about either side. He cares about making it fair. Now, once he's done, I give it to the buyer and the seller. Buyer and the seller then take it to the respective sides, and now it's taken that edge away of creating documents that neither side can live with, and making this go for weeks on the negotiation side for billable hours. What ends up happening is each side reads it, they bill a couple hours, they turn around and hand their responses back, they tailor make it to each side, and it's a lot more friendly and easy. So instead of getting to a point where the buyer and the seller, literally I've seen hate each other at some point during the process, it mellows the entire process out quite a bit and makes everyone feel a little better, a little more comfortable with each other, and it just creates a smooth process. So that's what we recommend when it comes to the transaction attorney. Now, when a buyer gets the information that he's seeking on due diligence, where does he normally go? He goes to his accountant. Now, the funny part is an accountant understands tax returns and numbers and QuickBooks and P&Ls and balance sheets. Okay, and that's great. It's all necessary in the due diligence process. But an accountant, in most cases, has never owned a company other than his own accounting practice. So he's probably the least qualified to do due diligence. But yet, a buyer doesn't know what he's going to do. So the buyer basically says, well, this is my account, I'm going to take it there. Now, what is an accountant going to do? He knows he doesn't understand from A to Z what's going on. He knows he's not going to be able to cover every base, so he's going to throw a caveat on the table. Now, if the buyer insists on going to his accountant, despite the fact we're going to recommend something else, we're going to tell him up front what's going to happen. We're going to say, by the time your accountant's done, he's going to say that there is certain things that came into play during due diligence that weren't as expected, and because of that, it's making this a higher risk, and he's going to say you probably overpaid for it. Okay, that's what you're going to hear by the time this is done. And that's his way of covering his base. If something ever goes wrong, he's going to be able to say, look, this is what I said. Doesn't matter how real it is or not, it's going to happen. Now, what we do is we recommend due diligence specialists. Make no mistake on that due diligence specialist, okay? He's not there to rubber stamp it or green light it. He's there to do due diligence. There is no such thing as clean due diligence, and that's all the way up to publicly traded companies. When you get into your due diligence process, you're going to find problems and issues, and they're going to come out. He's going to find them. The difference is he's not there to throw a caveat on the table with the buyer to cover his bases. When he finds them, he's going to explain them. He's going to explain why it could hurt him, what the ramifications are, but even more so, his job is to make the deal happen. So he's then going to say, here's what I would recommend that you do. Okay? And he's going to offer an alternative to what he perceives as a problem during the due diligence. So in essence, he's not there to kill the deal. He's not there to taint the buyer. I mean, think about it. If a buyer just goes to his accountant and he gets to the 3/4 mark and he finds out there's problems with the company, which there's problems with every company. It doesn't matter. If he goes and tries to buy another one, he's going to find the same issues. Okay? The difference is, instead of being told by his accountant, you got problems, high risk, overpaid, and then he stops back and says, what am I doing? What am I moving forward on? It can be a deal breaker. I mean, it's certainly going to take the wind out of his sails. On the flip side, now we're going to a guy who's an expert. He's going to say, you've got problems. Here's what we're going to do to mitigate them. Makes sense. Okay, it makes it easier. Now we've got a place to work from. Now, it doesn't necessarily mean from a seller side that that mitigation issue is going to be something he can live with or feels comfortable with, but it gives us a place to begin our negotiations, which we will, and we're going to make sure that we come to a resolution. So understand, there's so many moving parts in the sale of a business that when it comes down to getting it to the finish line smoothly and getting the money that you expected, it's all about managing the process. For more information about selling your company, go to website closers at youtube.com, and thank you for listening.